But I want to know, ask you, I swear I know my edge and my strategy, but I still have problems with my mind in the chart. Any advice? Well, I would need to kind of know what them problems are, because there's a lot of different problems which can arise when you're trading. In terms of a model, everyone knows Dodgy's model. Does that mean everyone's profitable with Dodgy's model? No, because it's the conditions that you're trading in. It's the price ranges which you're looking to play out. For example, if you're expecting to move lower, but price isn't showing you that it's going to expand with speed, then likely you're going to get chopped up, and at that point it's not a model fault. So I would need to kind of know more then. Would you say, what would you say the most important thing is to get profitable? My mentality is really good. I never revenge trade. I stick to my strategy, but the biggest problem is pattern trades. Can you show how to trade continuations? My mentor is PB. I don't really know much about PB, to be honest. I don't really follow the social media online that much. But in terms of continuations, what you want to see is basically this play out, where you have a range which we create. So it may be taking, say, sell side, for example, here, right? Then we create a new dealing range. So we take out maybe some buy side here, and then a continuation of the trend. So as you can see, we're bullish. The trend is bullish. So what you want to see is us retrace into some sort of higher time frame fair value gap of that price leg from dealing range low to dealing range high. Then within that, scale down onto time frames and wait for that model to play out, where you get, for example, the inverse like that, and then you can go break even at that swing high, and then that's the model. That's basically the whole idea of continuation models, and you're not trying to pick the top, you're going with higher time frame bias. It's just swing highs instead. Yeah, so they are good break even points. How do you get out of the break even phase? So the break even phase usually is to do with psychology, because your strategy has proven that it works. However, you're doing things over and over again to, I guess, limit yourself. So that could be revenge trading, taking trades you shouldn't do, losing one trade and taking another one based on that you want to make that money back. It's certain things like that you need to kind of journal down and slowly, I guess, take them out of what you're doing. Because if you repeat the same things over and over again, you're not going to get anywhere. In the break-even phase, you are likely to be in a stage where it's not the model at all. Like, your model is pretty good and your rules are pretty defined. However, there's certain character flaws in yourself which you need to work through. That's the main thing. And with character flaws, everyone will be different. Everyone would have had past experiences in life which would have caused them to do certain things and act certain ways in the market when trying to take a trade or trying to make money, for example, like that. How do you set TP? Like in general in trading view, well, if you're in a long position, do sell limit as a TP, and then if you're in a sell position, do buy stop. What does sponsored mean? A gap need to be sponsored. Which buy side liquidity would we target? So you can target so in this example, if there's an inefficiency in this price leg, you can target that as a partial. That can be your partial, that will be your break even. And then you want to see how we respond within that inefficiency. Do we trade into it and then start showing bearish order flow, or do we get through it and then use it as inversion and then continue trading to buy side, and then that would be your full TP, right? Or if there's another high here. Can you explain how to determine bias and draw on liquidity? Well, bias comes from where is the market going, so you need to have an idea of where the market's going to head towards. The market will always head towards inefficiencies or liquidity. So that's above old highs and lows, or fair value gaps, volume imbalances, liquidity voids, new week opening gaps, etc. So you want to see what pools of liquidity and what inefficiencies are closest to current price and see how we react or respond out of them. So into market open any day, I normally don't have a set bias. Like, I'll take longs and shorts intraday. It doesn't matter based on my bias. However, I'll have key levels drawn on my charts. For example, let's go on to Friday in here just before market open. What I would have on my chart is buy side liquidity. So if we are going to continue bullish order flow, so from this price leg low to where we currently are, order flow is bullish. We've been going higher. So that shows that the market is in a buy program and is seeking higher prices or inefficiencies above price. But I would also have sell sides drawn out, because if we show characteristics of bearish order flows, for example, we take this high and return into the range and then create a new range, then I would use that as a draw, a target. So I would have both, but it's basically liquidity and efficiency in terms of bias. Continuation won't have sweeps. They potentially can have sweeps. Like, for example, if this is the dealing range, right, you could have something like this. So you can see something like this, right? And on a lower time frame, there's an old swing low here, which is sell side. But on a higher time frame, this is all in one in efficiency. So on a day, so for example, this was a 15-minute chart. This is a daily fair value gap which gets created, right? There'll be a sweep of liquidity on a time frame lower than what the inefficiency is on. I obviously recommend watching all of ICT's videos. I've watched basically all of them, or I have watched all of them. So I'm not going to say you shouldn't watch it. I think that's the best source of knowledge from this source itself, or whoever started teaching it. Do you think it's okay to buy in a premium or sell in a discount if price looks like it's completely yes. ICT says a lot that the best longs will happen in a premium, the best shorts will happen in a discount. It's the same idea with breakaway gaps and how breakaway gaps form. So if we use this as an example here, right, this range here, so from range low to range high, so here to here, before this price move played out, right? That's a range which you can look at high to low. If you're waiting for a discount to be traded to, you would require that fair value gap. But if you studied ICT concepts, that would be a breakaway gap. The main reason being is because you see this range we created. That would be the characteristics of a balanced price range or breaker. So it would be favourable to leave the lower portion of it open and not trade down into that, because that is showing underlying strength in the market. If we're failing to get to a discount, that just shows strength within the current price. They are recorded, yeah, and they'll be on my YouTube. I'll just send a link later. In lower time frame, we have a lot of we need to react for that. Well, there's liquidity on every time frame, but beneath every high and low, even on a 1 second chart, there's going to be liquidity, right? It's just how we respond at them. Do we sweep it and come back into the range, or do we close under it and then keep displacing? It's whether we're sweeping or closing under, and there's a PDF which Dodgy has somewhere. It might be in here. It might not be in here. Any premium members, go into this channel, VIP Education, and there's a candle closure PDF. I think you can get it on his WOP or WOOP, but yeah. When ICT did lecture for institutional sponsorship, I can't remember if it was core content. It's core content month 5 or 6, I think. Or is it less? I don't know. Welcome department, no clue. He mentioned institutions get involved was more, so fairly that's weird. Wicks, retail movement, while the bulk of a candle is the main institution getting involved in it, so it's an FVG, nothing crazy. Oh. So that's a question. What are breakaway gaps? So breakaway gaps are gaps that you don't want to be filled in, that you want to be left open, preferably. So you can see the majority of the quick moves where displacement happens, there's usually a breakaway gap. So for example here, why is that not working? So for example here, there. So breakaway gaps will form when we are displacing quickly. You can see here, there's breakaway gaps. You can see this entire price run is breakaway gaps. So they're going to be fair value gaps which are basically being created with a lot of momentum in terms of that price will not trade back down into it, and it's showing underlying strength within the market. So breakaway gaps usually form, let me get a blank bit. So breakaway gaps normally form like this within this price leg where we have this breaker. So this is what ICT calls a breaker, right, between there, and it will usually form within that range because that is a balanced price range where we've had buy side delivery through that range, then we've had sell side delivery back through that range, and then we've had buy side delivery through it. So we've had a balanced price delivery where we've had buy side offered and sell side offered, and then we come out of that range. That's a balanced price range. So that range there is considered as a balanced price range as ICT teaches it. So once we trade above it, we don't need to trade back into it. So this breakaway gap will be within inside that range because that range is balanced. We don't need to trade back into it. So it's leaving it open. And when we leave breakaway gaps in place like this, that is the biggest testimony that we're going to see a larger range be produced if we have a higher time frame target on that. What time is best way to get? Well, just before market open, so like 9:20 or something. I usually mark out all my levels. If I've seen a bunch of people What breakaway could you test or enter by slide or and then wait for? Don't know really much about supply and demand. These are order blocks. So this is a a breaker. But if you think of every PDRA which ICT teaches, inefficiencies are just fair value gaps, volume balance, nothing like that. But then if you go to the other spectrum, which is ranges of price, so immediate rebalances, you've got order blocks, mitigation blocks, breaker blocks, vacuum blocks, so on, right? They're all forms of balanced price ranges on a certain time frame where this happens, where we have buy-side delivery, sell-side delivery, and buy-side delivery back through that range. At that point, that becomes a balanced price range, right? And then we don't need to return into it. So if we look at that on certain time frames, for example, 9:30 on Friday, this order block here, that range of it is a balanced price range. So you can see on a lower time frame, we would have had buy side delivery originally through that range, sell side delivery back into balanced price range, and then back buy side delivery through it. At that point, once that range of price is cemented in here, when we close above it, you can see how we just returned to the high of it. Let me just have the border. You can see how we just returned to the high of it, and then it's still higher. That's because it's balanced. Both sides are taken out for 30. Yes. Yeah, exactly. God of. Hey, price and nano. What advice would you give some trying to increase their win rate? Just to, like, you shouldn't focus on increasing your win rate. That will come over time when you refine your strategy, right? But my biggest thing is go for one-to-one risk to rewards. Anyone that is not profitable, even go to negative risk to reward. I promise you, it will make life so much easier. Like, you don't need 3R trades. You don't need 2R trades. If you focus on one risk to reward trades, think how easy that is to get one of them a day, a one-to-one, right? You don't need these massive home runs. Just go for base hits. And people don't like that because it doesn't sell as good. But lower risk to reward will lead to better, less losses. Less losses equals better psychology. You don't spiral out of control. Better psychology means better decision making, and then you can stick to your model. On evals, what do you think? 200 to 300. It depends, because it depends where you're at. Because like for evals, I'll risk a lot more now. But in terms, I would say 200 to 300 maximum when you're on a 50k. Being like Chris said, or Chriso, 500, that gives you 4 trades losing in a row. It's not as easy. Can you go over how to set a 1R trade after sweeping liquidity? But it's, for example, like I know, let's see for a pretty good example. What was the one before 9:30? Was it a 5 minute? Yeah, that's, for example, here. That's the 5 minute inversion, right? Just go for one-to-one risk rewards. So something like that. You don't need to try and have a really tight stop. And then as soon as we're getting this drawdown, you close the position because you're scared. Like, focus on less, because less is more in most things. You should never go into mini contracts on a 50k account. I'm being honest, I'm trying to pass before for, or it would be not nice having to pay the full amount, to be honest. Yeah. Lucid, if you haven't got any Lucid accounts, Lucid is better than Apex in general. It's cheaper if you plan on passing them. If you plan on failing the account, then Apex is cheaper, but why would you plan on not passing? Well, you just have to, OJ, you just have to wait for a new, I guess, setup or new confirmation to play out. So you want some sort of internal model to play out after that. Second liquidity super. Well, it's because, Rave, I'm going to get off in about 20 minutes, so it's not worth doing some back testing. But I will plan on doing more of these, because I know Dodgy doesn't do them as often now. Why does price often come back for a second liquidity sweep and hit my stop loss? Well, it's because of time, mainly, or higher time frame, like, draw is not met right now. Like, for example, here. Right, we got lows down here. We create a high, fail to displace to that low, right? So when we come back to that high, sweep again, and then we start showing bearish order flow, right? And you're just getting in the move too early there, and you just need to recognize that we're not displacing. Like when, for example, in here, when we're not closing under old lows, in general, I want to see speed through ranges like that. When we're trading into the first low like that, you want to see speed through that entire range. You don't want us to trade into it and then reject. You want to see speed through it. What do you think of this? Sorry, I'm just watching something. Well, yeah, it's just waiting for that video, OJ, what you just sent. It's just waiting for a higher time frame draw to be met instead of just responding from price like pattern trading without narrative. So on Friday we can see that range from like 9:45 to market close a breaker 9:45. I don't know what you were. Could you send a picture of that range from 9:30 to like market close a breaker? What, that range? I wouldn't mark it out as a breaker. We're at all-time highs, right? So that is a consolidation. If we are bearish, that will be used as a balanced price range. But because, for example, like it's likely us to trade back towards, is that the old all-time highs? It's likely we trade back into this range here. And then this inefficiency, because that's inefficient price delivery. And then if we're really bullish, we're going to leave the lower portion of this open as a breakaway gap. But where we have up and down price movement like that, for example, in an hourly, you're going to see the overlap of that, where buy side and sell side delivery has been met. Sizing on evals to pass them quicker, and then being more safe on fundeds comparatively. I wouldn't recommend going aggressive on sizing. It depends if you're profitable or not. Like now, if I was doing an eval, right, I would go more aggressive. But also, like, that eval doesn't mean too much in terms of, like, I would rather pass it quicker than spend the time passing it, because that's more valuable. When trading at all-time highs, you should always look for all-time highs to be targeted. And you just kind of want to see this play out, right? Where we have an all-time high here, and then you kind of just want to see this, right? And then the same thing, just like literally like that, where we have higher highs, higher lows, higher highs. That's what you want to see. You just want to look for, yeah. It doesn't mean you can't short. Like, you can short into short-term discounts. Like, you'll see Dodgy take shorts at all-time highs, because you can. Because we need price to go lower into a measure of sell sides to go higher. It's not just going to keep going higher with no opportunities for a measure of sell side delivery. Can you tell a difference between an actual breakaway gap and just a volatile good close IFEG? Can you tell a difference between an actual breakaway gap and just a volatile good close FVG? Well, there will be certain scenarios where I'll say I would, like, before an even fair value gap has formed, or a start of a fair value gap has formed, there's areas in price where I always say I want to see a breakaway gap form, and that's going to be near the start of a price run. Like, when we're creating a low, taking out a previous high or low, for example, taking out this high here, did we change it? So, for example, taking out this high here, what I say, the first characteristics of a price run, which would likely go in my favour, is a breakaway gap. And I would want to see a breakaway gap form, because that shows I'm on side, that shows I'm in direction of, or in the right direction of the market. And my trade is likely to be in a low resistance manner. On funded, I take it very slow. I'm at 3K, then I need to lose my edge because of the time constraints and everything. Yeah, that's an issue. Like, yeah, Bruce. And people are in such a rush to do evals nowadays. Well, drawing liquidity is more important, but you also need to understand high resistance and low resistance conditions. I did this diagram in Coffee and Chill the other day. That's a breaker block, so just where we have a low, high, lower, low, higher, high, and then that's a balanced price range. And then a rejection block. You don't need to know what a rejection block is. And I know, I just don't want to explain it because Dodgy would have taught it a different way. You don't need to know what a rejection block is, due to the fact that it's a topic which ICT has taught in its core content, and other people have changed the definition of it. So just you don't need, it won't make a difference really in your trading too much. So something market sweats some type of liquidity and leaves key levels below. If we get a good inversion from that sweep, should I take it with key levels below? Well, you need to, if your higher time frame bias is towards that key level, then don't take it, because you want to wait until that's hit. That's your trading model, that's your trading plan, that's what you want to see before going into it. But if it's there, it's got momentum, we took a measure of liquidity, and we have a higher time frame draw, like relative equal highs, or just an inefficiency above market price, it's not a bad trade to take, in my opinion, if it's got a decent break even, and also we're responding out of a PD array which could support price. So for example, like, there's two inefficiencies in a price leg. For example, like, we have a price run like this, right? If there's two inefficiencies like this, right, and there's an hourly here and a 15-minute here, and we're looking at a 1-minute chart, for example, right? If we do something like this and then get like an inversion like that, That's not a bad trade to take in my opinion. And it might not be an A+ setup because we've got a higher draw, but if we have relative equal highs, for example, I don't know, there's a high here as well, so we have relative equal highs above, or equal highs, we'll just say equal, because that's what Dodgy teaches. That's not a bad trade to take, because there's a good break-even point. We took a measure of liquidity. If it's just liquidity, like, for example here, if there's a low, so forget the inefficiencies, then it's the same idea, right? But for example, if it's like a price run like this where we've had an expansion, we rebalanced into a range, then that model will be okay. But for example, if we've done something like this, for example, if we did something like this and got a little inverse here, right, with a higher time frame draw lower, you have to be more cautious because our buy side's been taken out, so these relative equal lows are clean, and you may see them want to be traded to. So if there's not a clear displacement and you still have relative equal lows, your high time frame draw beneath price, it wouldn't be ideal to be long in away from that. That doesn't mean it still won't work out, but you always have to want to follow your higher time frame. How many trades do you take a week? 3 trades maximum a day. Usually 2 losses finish for the day. If I take a loss first, then I'll take any win after that, I'll be finished. And then if I take a win, I'm allowed to play with the profits of that win. And if I go break even of them profits, then I stop for the day. Because in some cases, that might just get absolutely ran as a second stage distribution of a market maker sale model. If we're going to the other side, do you want to draw a chart layout out for me? If we're going like to the other side and price took major liquidity, do you want to just draw like a little diagram? Like I was drawing, because that'll be easier too. Okay. But in terms of, like, let me just get a picture up for a second. This is what most people should study, the difference between, and Dodgy goes on about it a little bit. For example, for example, these are 2 different charts, right? These are 2 different charts. Let me get one. I'm just going to do this. What one in here, these price runs, so the right chart, looks cleaner to trade in. They're 2 different types of delivery, right, in there. So this is of the same day, but they're 2 different price runs. When we're inside of this range here, you can see the overlap of PD arrays, the overlap of price. We're very back and forth. Them conditions you're going to destroy yourself in. But once price transitions to a breakout or a low resistance run, for example here, once we take this buy side, once we wait until buy side is engaged, you can see that price run there, right? And that took out the entire range of that. How long is that? 2.5 hours of price consolidating like that, giving high resistance delivery, was all taken in a low resistance run in 30 minutes, right? They're the price runs you want to try and capitalize on, and it's all about us taking higher time frame and leaving breakaway gaps and displacing away from the range. Because in here, you can see how every single fair value gap which we are creating is getting overlapped a lot. There's no clear direction. And that will look like that on higher time frames when all the candles are overlapping. When every single candle is sharing the same body candle range of previous candles, that is just high resistance conditions. And it's just best to stay out of it, right? Whereas, for example, this price run, you can see how on a 5-minute chart, you can see we're just printing down closed candles, right? Short-term retracements, not even returning to premium for range. That is low resistance, and look how much easier that is to trade. So it's understanding characteristics of how to spot them in advance. Obviously, you can't go into it saying, okay, I want to see it now, but over time, journaling these conditions, you'll know which you are likely to see. It all depends. So I'm going to show. What day was it? Tuesday. Sorry, I just need to find. Oh, was it Monday? Yeah, it was Monday. So you see this morning session on Monday. You can see how high resistance and overlapping that was. So in here, I mentioned the only way I wanted to see higher prices is if we started closing above old highs. Notice how we never really close above any old highs in here at all. You can see how we're just sweeping them, right? So that's not characteristics of a expanding market. What you want to start seeing is us start closing above old ranges. So for example, ranges in price like that, that's your breaker. And you can see how we're closing above old highs and staying above them. We're not just, hey, this is a very high resistance one as well, to be honest. Not a great example, but we're continuously now sweeping old lows, not displacing under them, and then closing above highs. That's what you want to look for, and I don't think it's a great example. Give me a second. Where's the execution of it? Yeah. So, for example, that's the execution. Once we start closing against opposing PD arrays, this was only paper because of a day, it was awful. But once we start closing over old highs and old lows, that's when the algorithm is going to switch to a buy model, a buy program. What about the chart one at the 10 a.m. where it swept below and left side bound for buy side? Would you have taken a trade? I could potentially take a trade in any of it. That does, like, I can't say it in hindsight whether I would have took it or not, because there's other factors which would come into it, whether what time frames was I looking at, and what conditions we were seeing live in price. Even in conditions where it's consolidated, for example like this, there's still nice price runs, but you're not going to hit the one-hit wonders. Thanks, I guess. Nice journal. Again, I normally have a bit more, like, I find it easier to talk over live price because I think live price is a lot more interesting too. I do normally go live in Coffee and Chill most mornings for channel beneath us. For AM session. What else should I cover? But yeah, the main thing is just understanding what conditions you are in. Because like I was going on earlier, right? In a high resistance condition where price is being confined to a range high to range low, I will blow my accounts in. All of you will blow your accounts in. There's no stopping that, because you're trading in a condition where the market isn't expanding in one direction, isn't delivering price like efficiently or trying to get somewhere quickly. It's just staying within a range, and within them ranges you're going to blow your accounts, and as well I will blow my accounts as well if I'm trying to force something in there. You kind of just have to go into the mindset of there's always going to be another day. Like, the day you're trading isn't going to be the last trading day ever. So just old highs and old lows, KT, probably. But that's the number one thing you should focus on. Like, trading is probably like 40% technical. I know people say it's less than that, and it's like 80% psychological, but it's probably about 60% psychological. Like, you obviously need the technical ability, but you need to kind of master yourself. Past 10 a.m. I personally wouldn't look to take anything after there, just because we've had such an expansion move higher and we're at all-time highs. But when the market is this overexpanded, we're going to get a retracement. So then you cycle through your time frames and look for potential PD arrays we could trade into. So for example, on a 50-minute, we have two 50-minute fair value gaps. They're both draws. Don't volume balance there though. And then you can see how we trade into the lower one there by a tick. So that's also sell side. So that's, even though we're still bullish, you can catch these shorts into a discount array. Like, you can't expect us to continue climbing higher when we've, for the day, already moved a total of 400 points nearly. At that point, we can just consolidate or just retrace into a range to a fair market value. So when the market is this high, above all-time highs, the market will want to deliver fair value, and that's going to be within that range and inefficiencies. And then you can see the bodies wicking down into the lower fair value gap, wicking down into sell side, while the bodies are remaining in the 50-minute fair value gap above. What do you mean? I would just, you can withdraw, like for example, Take Profit Trader, you can withdraw with PayPal. PayPal take, I think it's a 3% fee on that, so you get the 90 split, then you have to pay 3% PayPal, and then at the end of every year, Take Profit sends you a IRS or overboard IRS like documentation, which just shows all your payouts and stuff with that firm. And then I got an accountant that sorts all my tax. I don't really know can you send a picture of the rules of Tradeify search account? Because I have no idea. Is BPR important? Well, it depends what BPR you're talking about. Like for example, Dodgy teaches balanced price ranges. For example, this, right? This is a balanced price range. That is a balanced price range to a certain extent, but balanced price ranges come into form in a lot of different ways. So just any range which has had buy-side delivery, sell-side delivery, and buy-side back through it. So for example, with bullish, it would be something like this, right? That's a balanced price range. This whole range here, where we've had sell-side delivery and then buy-side delivery back through it. That's a balanced price range. And then when you're bearish, it's you create a high, trade through the low, and then that's a balanced price range once we close under the low. Same again here, that becomes a balanced price range once we close under the low. But if you study breaker blocks, mitigation blocks, order blocks, they're all types of balanced price ranges. Just trade it like you did with the eval. Or are you on the eval, maybe? Is it? Oh, for a new project. Okay, one sec, let me read the difference. I would say daily if you're a new trader. A mitigation block is just, I just nearly left this call. A mitigation block is just that, where we have a low, high, higher low, higher high. So it's just a failure swing of the breaker block. So them ranges there that I've annotated are balanced price ranges. Put in chat. I'm probably going to get off in about 5 minutes because I got stuff to do. If you've got any questions, please say. I'll try and answer them. Neil, before I go off. But for example, like this is like a example of a balanced price range on a higher time frame. So you have a low, or you have a low, high, lower low, higher high in here. And then you see how we return back to the old high and no lower, because that's a balanced price range. You can also mark as ICT teaches to breaker as that. But I don't trade support and resistance, but technically it's like this. That is technically support and resistance. Resistance turned to support, but it's using ICT concepts. I use Fibonacci for projections at all-time highs and just gradients of certain levels. And these are the fib settings I use, but let me do it on this one. Maybe not. They're the basic fib settings. Yeah. How do you know what day OPEX is? Just look up on Google OPEX days and then go on to the first website, and then anyone that says with the box around here is OPEX. So it's the third Friday of every month. So for example, at all-time highs to project highs, for example, just use ranges. So ICT teacher as just ranges. So you can project from breaker ranges, mitigation ranges. So here you're just projecting a lot of different ranges of price and see where they meet up or align, because they're just mathematical levels. There's not really much in them. So you can see there, for example, trading into it, so you can see that cluster of them there. And then for ranges, I just use quadrants. So for example, like I would see where we are. Yeah, it's the same with fair value gaps, and quadrants are quadrants. Like there's probably quite a lot of videos online explaining it. Here's your time frame. Well, so what I'm looking at on one of my charts, I have my charts. So I look at higher time frames. So I go monthly, weekly, 2-day, daily, 12-hour, 8-hour, 6-hour, 4-hour. Then I'm looking at the hourly, 45-minute, 30-minute, 20-minute, 15-minute, and 10-minute on this chart. And then what I'm normally staring at on intraday is this on one of my monitors, which has all the time frames on, and that's basically using the price delivery continuum as ICT teachers. How would you just buy one extra or scale more? What, one extra account are you talking about? How would you scale your trading for 50Ks? Yeah, just buy another 50Ks and group trade it on Tricopia or something. Well, entries, you want to see them form around the quadrants by entries. It's just using premium and discount. Like you don't need to worry about it too much in terms of where it is, but usually it's going to be, well, your entries are going to be while taking high time frame liquidity, so an old low or old high, and then you could look for 50% of that range as well. So you could potentially look for us to trade down into 50% of that range while trading into that low, into that inefficiency, and then get your entry model. The market will want to deliver to 50% for fair value, yeah. But if we're failing to get to 50%, it shows underlying strength or weakness in the market, depending if it's bullish or bearish. And the further we go down beneath 50%, for example, if we're bullish, the further we go down this way, so if you're bullish, the less likely we're going to get a low resistance run. So a run which is going to expand quickly like this. So for example, in here, you can see how if we're looking at this range from range high, low to high, you can see how we stay in the upper quadrant. We don't even come down to 50% because for balanced price range, which I was talking about earlier with breakers. So you can see how we trade into this short-term low and that fair value gap there, and then trade high. Any more questions? But if that's the case, would you not consider longing into a premium? I long in premium. I don't need it to be in discount to long. But that will come with experience. Like, I'll long up here because the higher time, like this is all balanced, like what I mentioned earlier with buy side delivery, sell side delivery, buy side delivery back through it. So at that high, that's balanced. Whereas the only range which isn't balanced, we have buy side delivery through here, which just means price is going up through that range. And then we've had sell, and then we're delivering sell side delivery to that range. And then once that's met, then we're just waiting for time, so 9:30, and then we continue delivery. Liquidity is basically invalidated. Well, beneath here and here, for example, because liquidity's already been swept here, you have to look at this as we've made this jagged. So the shark has bit into here, and then we've traded away. So the damage is already done. Remaining reduction, we're currently going, what, this low here you're talking about? Oh, no, I'm talking about, I was talking to remain in the direction we are currently going, I always see So 0.3 to or even 50% of range untapped. If the draw is strong, especially at times we miss 50% a lot. Yes, because of the underlying strength in the market. Yeah, that's true. And that's why I don't really want to see it into a discount at all-time highs. Because you want to see quick expansions in the premium to show continuation. We have it at 6. I don't know. I would need a timestamp on that. What's that Fibonacci draws on the wicks of quadrants? You just use it the same as an inefficiency. Let me get a good example because I'll be able to find one. Example here, right? Got quadrants on the wick. And then if you're bullish, you don't want to see us trade to close under 50% of it because it shows strength. It's like in fair value gaps. You don't want to see us close under consequent encroachment because that shows strength if we're bullish. It's the same principle with wicks. Yeah, near enough. So for example, in here, within that wick, if we draw that wick out quickly and that range in time, you can see on a lower time frame, there's going to be an inefficiency there, which we're trading into. So for example, there. Beautiful. You see how we balance to that candle's high? That's a balanced price range. And this scales down onto time frames. So all wicks are inefficiencies on lower time frames.